Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. Well, the global equity markets are experiencing significant turbulence with major indices under pressure and heightened volatility across the board. From New York to Tokyo, equities are facing losses, and the VIX, Wall Street's fear gauge, has surged to levels not seen since the early days of the pandemic. Now, gold prices have been affected as well. Now, this downturn in gold is part of a larger trend affecting commodities across the board, driven by concerns over a potential slowdown in the U.S. economy and, of course, fears of a recession. Joining us to discuss what this means for gold and commodities is Mike McGlone. He's a senior commodity strategist at Bloomberg Intelligence. Welcome back, Mike. Thanks for joining us.
Thanks for having me back, Jeremy.
Yeah, I was reading your notes from this morning, and you mentioned that there's some spooky similarities to the global financial crisis here. I mean, an interesting week, to say the least. What are you seeing, and how might this play out maybe differently than then?
I think it's going to be worse based on my indications. First of all, you just look at stock market volatility, the VIX Volatility Index, 52-week moving average minus T-bill rate is as low as it was in 2007 when I had some major signals that volatility will always revert upwards. You look at U.S. stock market to GDP, it's basically 2 times that. Before the financial crisis is about 1.3 times. Cash levels now are about 10, 11% of total market cap. Before the financial crisis, they're closer to 15%. So the science here, and also one thing that's really significant on a global macro scale is China's heading towards a pretty severe recession, maybe depression. Just look at their bond yields. The 10-year note yield at 2.15 this morning is well below that US Treasury at 378, 379. And I think the whole world is heading that way. And that's the big difference from the financial crisis. It was kind of the US led. Now I think it's global macro.
Yeah, it's fascinating what we're seeing. You mentioned it. There's this dramatic sell-off across the global markets. Stocks are plunging, and there seems to be a flight going to Treasuries. Obviously, there's lots of talk about the slowdown in the U.S. economy, but you mentioned globally. So is that what's driving this panic? I mean, how do you think it's going to impact short term here?
Well, first of all, it's not so much what's driving the panic. This is normal mean reversion at the moment. The S&P 500 at about, as we speak, 5,200 is well above its 200-day moving average at 5,000. There's still a lot of room for it to just catch up. It's just an example of what typically happens in markets is the most powerful force is mean reversion. Markets just got way too expensive. Then we saw kind of the plunge in the yen carry trade, the give back of all that liquidity there. But I think to me, the best leading indicators for all this has been Bitcoin. It trades 24/7. It's massive speculation, has very high volatility. It started breaking down on Saturday, then Sunday. It should have told you what's going on. But to me, this is just the beginning of a normal market correction. And when you hear everybody say buy the dip with the S&P 500 still well above its 200-day moving average, ignore them and let markets work. But we might have some short-term bounces. In fact, we should. The Fed is going to ease. I mean, they are way above the rates of inflation in this country. But to me, it's the macros I pointed out earlier. We have just a long-term example of risk assets getting way too expensive. Cryptos were a good example of that. I think gold's going to come out ahead. Now, it's getting a little bit hit today, but it did begin in 2008. But there's some key differences that I think are more supportive for gold this time than last time.
Yeah, let's get into those key differences. I mean, you mentioned it. There's been a bit of volatility in the market, but relatively stable here. I mean, is this a pivotal moment for gold? When we see this correction coming, gold is struggling to retain stability, but it seems like maybe this could be an uptrend.
I think you're right. So that's a key thing now. If you overlay like a 200-day moving average of gold, Bitcoin, and the S&P 500, they're all heading straight up. And one of them's going to, I think only one's going to win out of that. And I fully expect 200-day moving average to tilt lower and Bitcoin to tilt lower and S&P 500 as they tilt lower. But gold has one key difference, is it is a store of value. And it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring it right now, is managed money futures positions are pretty stretched long for a bull market. They're getting stopped out. It's one of those environments. It's not a want to sell. It's a got to sell. You sell what you can. And that's happening in gold and Bitcoin. But gold's going to come out of this ahead because as a percentage of compared to ETFs, are much more significant than futures were back in 2008 when gold went to 1,000. It dropped to 700. And then it started to move all the way up to 1900. So I think this is a normal reaction. But the bigger picture problem is beta. It's a U.S. stock market, S&P 500. It's way overdue for maybe a bear market, a normal correction. And right now we're at the stage of a normal back and fill. And I think people should be very careful when people say buy the dip, when markets, it hasn't even touched its 200-day moving average. And I just mentioned a few weeks ago, it was the most above its 100-week moving average in almost 2 decades, with the exception of the big money pump from COVID. So to me, normal reversion. Commodities predicted this. The S&P, I'll end with this. The S&P, the Bloomberg Industrial Metals Spot Index was its peak earlier in there. It was up 24%, and it dropped to down on the year just a few weeks ago. It was telling you there's something wrong.
Yeah, and there's a lot of talk about the margin calls. Obviously, we know that when that paper actually hits the market, it takes a few days. Is this more smoke than fire? I mean, you kind of got into it there, but long term, what are your projections? Short term, what are your projections once this fire or smoke clears?
Well, the smoke will clear. There's probably this is a tremendous environment for those more tactically oriented. But I think this is the big that I started writing about 2 years ago. And I mentioned volatility is at multi-decade lows. The market capitalization of the U.S. stock market to GDP is the same as it was last time. It was this much higher. This at this kind of level was 1929. We know how that one worked out. And then we have things like the yield curve. It's still extremely inverted. If you look at the 30-year yield at about 4% and Fed funds at 5.5%. So it's just starting to uninvert. It's been 2 years, and it was that classic pendulum. We swung way too far towards recession a year ago, swung way too far back the other way. Now we're just singing back. The problem is, the difference is there's a significant delayed reaction. And I earned that nickname last year of Mick and Gloom. I'd like to say I'm Mick Facts. The facts of normalization in markets are pretty severe, and there'll be significant bounces. There'll be great opportunities. Everybody will say buy the dip, and I'd say sell the rallies.
Yeah, interesting. I mean, you mentioned it. Obviously, commodities and markets themselves are cyclical. I want to get back to gold because you suggested that gold might bounce back after some consolidation. And you're tracking the US Treasury prices. Obviously, those are going higher. Explain to the audience a little bit about this relationship between gold and Treasury yields and why you see this as a more supportive factor for gold.
So I'll reiterate what I've been saying for at least a year. I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars. Now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. But in this case, I think those are the two best potentially performing market asset classes in the next few years as we head towards this global recession, which is clearly the case in commodities, and that is gold and U.S. Treasury long bonds. So here's one thing I published recently, Jeremy. A few months ago, I pointed out if you take the average of the top 5 countries in the world outside the U.S., including India, the average of their 10-year note yields just recently reached 100 basis points below the U.S. Treasuries. U.S. Treasuries were that high. Now the U.S. Treasuries are catching up. Typically, U.S. Treasuries yield a lot less than the rest of the world. And so to me, that's what's happening. That's why I think Treasuries are still the place to be, despite people talking about deficit spending. Now, that's a bit of a problem, but it's deflation and inflation that matters. And commodities, certainly industrial metals, are showing us clear deflationary forces. And if we just get more backup in beta, that's just normal deflation, reciprocal to significant inflation on the back of the biggest money pump in history to the peak in 2022.
Yeah, a ton of money coming into that market. No kidding. Okay, you've highlighted the future speculators are heavily long in gold and copper. Talk to me about this, how this positioning is affecting the market dynamics here, especially amidst this recent sell-off in other commodities.
Well, when the market pumped up to the peak in 2022 and then fell to where it is now, it was a commodity market. Now we're switching back to a market of individual commodities. And crude oil was a great example. What drives these futures markets are speculative futures. Managed money net positions in futures are good indicators. So petroleum futures got way too long at that peak early in the year in the 80s, and then got sold out completely as we flushed down to 69 or so in WTI. So they're basically sold out. So crude oil is basically somewhat flat in terms of managed money net positions. But what the key thing was this year was copper. That copper high, $5.20, was almost completely driven by pretty significant massive buying in speculative futures. They got to the highest level in about 4 or 5 years as a percentage of open interest, over 32%, and that's CME and LME. And now they're still getting flushed out. But the problem is, typically these bottoms in copper come when the positions get flushed out to maybe 5% open interest, and there's still 20% of open net long. So they're getting stopped out. And so that's where you really see that. You definitely see it in the grains. The grains are the best leading indicator because they have the highest elasticity supply and prices. And the grains have been way sold out all year. Massive short positions. Why? Because it's in a significant bear market. Why? Because there's massive supply. And the main reason was because of the big pumps in prices. So it's that autocorrelation factor that's kicking in commodities. You can see that in managed money net positions. It's trickling down the equities now. And the bottom line is commodities are showing us deflation. Cryptos, I think, are signaling there might be more of that. And if we just have a little bit of more back and fill in the stock market, that's pretty severe deflation that is pretty much overdue if you look at the lessons of history.
Yeah. And we see the sell-off, as you just talked about, and obviously we're seeing this rush towards T-bills or treasuries. So, I mean, without calling the trade here, I know you can't give individual advice, but I mean, where are we putting our money? Are we going towards gold in this market? Is there some type of conditions that are better than others, or is it T-bills?
I think there's times to be underweight risk assets and overweight risk-off assets. And I think in the next few years, some of the best performing assets will be gold and US Treasury long bonds as we tilt towards a deflationary period reciprocal to inflation that we got to the peak in 2022. It's happening globally. Keep an eye on China. It's happening in Europe. We see issues in Canada. The question is what stops at this juncture. We will see cuts in US interest rates, and they're still pretty high. But I'll end with this. The U.S. unemployment rate, it's 4.2 or 4.3%, bottom last year at 3.4%. It's never bottomed that low without going to 6%. And that's just 100% probability since 1947. I suspect that might work. Let's see how different it is this time.
Yeah, history certainly says some things. Okay, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, joining us. I know it's a busy day, man, so thanks for making the time for us today, Mike.
Thanks for having me on, always.
Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We got some great content coming up, so hit that notification button to stay in the loop. We'll see you next time.